Hello class, welcome to this chapter 3 lecture video. We are going to make 2 lecture videos for this chapter. In this first one, we're going to talk a little bit about the difference between cash and accrual accounting, and then look at some adjusting entries. And then on the second video for chapter 3, we're going to look at the closing entries and rounding out the accounting cycle. So let me go ahead, get my slides ready, and we'll get right into just got to share my screen and we should be good to go. You need your chapter 3 outline is kind of what we'll be going through. So beginning of chapter 3, yes, we start talking about accrual accounting. So we're going to be able to explain the difference between cash base and accrual accounting. We're going to use some of those assumptions and those principles that we learned in chapter 2. Now we're going to actually start applying them. Okay. And then be able to get that adjusted trial balance, prepare some closing entries and trial balance so you're able to make your financial statements. All right. So go ahead, Jen, please. Okay. Accrual versus cash basis of accounting is the first thing we want to talk about. Okay. Cash basis accounting is not GAAP approved. It's mainly used for small businesses. Okay. And that is when you do not record anything until cash actually changes hands. And so if you came to me and you worked on my car in December, but I didn't pay you until January, you wouldn't recognize any revenue until you got paid in January for that work that you had done in December. Okay. Accrual-based accounting, it's an alternative to cash-based accounting, and it is required by US GAAP. So that's what we're going to be learning. Under accrual-based accounting, transactions are recorded when they occur, regardless of when cash changes hands. Okay, and that is our revenue recognition principle and our expense recognition principle. Okay, remember, revenue is the value that we receive for our goods, selling our goods or services. So it's basically what we charge. Okay, so as soon as we do those services or transfer those goods, then we can recognize the charge as revenue. And then expenses we have to pay when they're incurred, not when the cash changes hands. Okay. When does the company account for earned revenue if it follows a cash basis accounting? Well, if it's a cash basis accounting, earned revenue comes when cash is received prior to the services or at the time after the services. It doesn't matter if we're using cash-based accounting. If we were doing accrual accounting here, our answer would be A. Okay, so it's D for cash-based accounting, but accrual accounting is what we're more concerned about, is when services are rendered, even though cash may be received at a later date, we're still going to record our revenue. So what we're going to do is, because of some of these things we talked about for accrual accounting, the time period assumption, the revenue recognition, and the expense recognition principle. So the time period assumption is what we talked about in chapter 2, where we say time can be artificially broken down for a company. So we can report on a monthly basis, a quarterly basis. At some point in time, that year is going to end, or that quarter is going to end, but operations just don't stop. Operations keep running through those days. Okay. So we need to make sure that we get our revenues and our expenses into the right time period whenever we're making our financial statements. That is the revenue recognition principle. Revenue is recognized. That is when we record it, we put it into our journal entry as a revenue in the period a company satisfies its obligation or promise within a contract. That's what I've been saying there is when the service has been performed, or the goods have been delivered. That's its performance obligation. Revenue is always recorded then. If they paid us then, yes, then we would record cash also. If they did not pay us then, they're going to pay us later. Remember, that is an accounts receivable. The expense recognition principle says that an expense is recorded when it is incurred, regardless of when it was paid. So if we used up $200 worth of electricity and we received the bill, but we haven't paid it yet, but we've already used it, it becomes an expense in the period that we use the electricity, not when we actually send out the bill. Okay? There's other things, such as the expenses must be recognized in the same period of revenue that helped you generate. Think about supplies. We might have spent $3,000 in supplies on January, and we're still using them in March to generate revenue. Okay, so we're going to need to expense some of those supplies as we use them up. Depreciation expense. Okay, it's something that as property, plant, and equipment gets used up and it's generating revenue by using that equipment, we need to put some expense in there. So we are matching the revenue generated. All right, so just thinking about the revenue recognition and the expense recognition principles, here we have an example. The state of Georgia hired a company. Okay, so in November, they incurred $60,000 of expenditures. They also delivered its recommendation and billed the state for its work. So in November, they did all the work and had all the expenses incurred, but sent out a bill. They paid off their expenses in December, but they did not get paid until January. When it says calculate the net income for November, December, January using the following method. Well, if we use the cash-based method here, even though everything was done in November, this company is going to show no net income for November. Because they had no revenues, no money came in, no expenses went out, even though they were incurred and the services were performed. And the cash method, we're only worried about the cash. So in December, we showed 60,000 loss. In January, it would show 100,000 net income. Okay, it just makes it a little weird because you don't know when the timing of these really happened. Under accrual basis accounting, you see the services were performed in November, so revenue goes in November. The expenses were incurred in November, so they go in November, regardless of when they were paid, showing that in November they made a $40,000 profit off of that job, which more accurately depicts what actually happened in the scenario. Okay, so when we're doing accrual accounting, sometimes we're going to have to make adjusting entries. Okay, for some transactions that may or may not have been done yet. Okay, this is necessary to apply that revenue recognition and expense recognition principle. Think about it, if we are going to stop reporting on June 30th, call it our 6-month report, and that falls on a Wednesday, but we don't pay our employees till a Friday. Those employees that worked Monday, Tuesday, Wednesday in June, they had expenses that were incurred that month. So we need to make an adjusting entry here to adjust for something here that has not been paid yet. Okay, that's kind of what a quick example of one of the things we're going to go through. But that's why adjusting entries are need to be made. So that way we record the right revenues and the right expenses into the right period. So we are not misleading our investors. Okay, it is timing differences. It gives rise to two different types of adjusting entries. We have accruals and deferrals. Okay. Accruals have already happened, but have not been paid. Okay, we're going to go through some examples of those. There's something that has already happened, but we're going to take that we've done the work, but we haven't even sent out a bill yet. Okay. Or this is where maybe we have those electric bills that come in. We've already used the electricity, but we have not paid it. We haven't accrued expense. Whereas on deferrals, is where the cash has already been exchanged basically, but there's something owed. Okay. So we have deferred revenues. This is where somebody pays us cash before we do any work. Okay. You remember from our account, that's called unearned revenue. And then as we do some of the work, and then we can make adjusting entries to make that unearned revenue into revenue. And this is where you also have deferred expenses. We've already paid cash, 6 months ahead for our rent, and we've already paid the insurance policy for a whole year. So we gives rise to prepaid assets, prepaid expenses, which are prepaid expenses, which are defined as assets, you know, a prepaid rent, a prepaid insurance. What else could you prepay for? Well, you can prepay your utilities, I guess. All adjusting entries are going to affect at least one income statement and one balance sheet account, because the point of making these adjusting entries is basically to make sure our expenses and our revenues are correct for our income statement. But they're always going to be offset with the balance sheet account, so it's always going to affect both of those statements. So if we didn't do these adjusting entries, if we forgot to record the expense, it's going to make our income look higher than it actually is. If we were looking at our income statement, and if we were looking at our balance sheet, it's not going to show that we owe that money either for those salaries. So it's going to make our liabilities look lower than they actually are. And this type of misinformation could very well mislead investors. So adjusting entries are very important. We're going to adjust these entries. Step one is to always identify. So we're going to need to identify which accounts we are dealing with. Step two, we need to calculate or measure. That's only step two in the accounting cycle, the amount of adjustment based on the amount of revenue earned, expense incurred during the accounting period, and then make our adjusting entry. Okay, so our different types here. We have accruals. Accruals, remember, already have happened but not been paid. So if we have accrued revenue, the company has performed its service obligations but not received the cash yet. Give some examples here. Interest on outstanding loan has been earned but not yet paid. It is accrued revenue. Because most of the times, if you sell something on interest, you're not going to require payment for 6 months. And every month, if you make financial statements, you're going to have to go through and see how much of that interest have you actually earned in 1 month. Because they were telling pay off early, they would pay interest for basically 1 month. It's necessary to record revenue or accrued revenue, something that has not been recorded yet. And the associated increase in the company's assets, usually a receivable. And so, yes, if we've earned some interest off a note, we would have, but they're not going to pay it for 6 months. When they pay back the note, we would have interest receivable, an asset going up. So we would debit that, and we would have interest revenue going up. So we would credit that, thinking back to our dealer acronym. So here we go. The rented office space to be occupied immediately, trying agency for $5,000 per month. Porter requires them to make a rental payment at the end of every 3 months. No payment was made on November 1st. So they're not actually going to make a cash payment at the end of every 3 months. So not till the end of January. Okay. So to prepare our adjusting revenue here, identify what's going to happen here. Okay, well, at the end of November, they have used a month's rent. We are owed now. We performed our obligation. We can recognize revenue at 1 month's rent. Slides are wrong here. Okay, they're saying they're not doing it monthly. I was confused there. Okay. Entering an agreement to pay him $5,000 per month. At December 31st, okay, we have now received, they've used the apartment or the building for November and December. We still haven't received any rent because we're not going to pay it till the end of January. We go to close our books on December 31st. First, we find out about, hey, we need rent revenue now. It's the end of the period. We need to put some of this revenue in the right period. That's why we're doing adjusting entries. And to coincide with that is our rent receivable, because we are owed that now. We know we're getting paid January 31st. Calculate the amount. At December 31st, there have been 2 months used. They agreed to $5,000 per month, multiplied by the 2 months they used in November, December. So we are now $10,000. So we will record our adjusting entry as rent receivable a debit and asset increasing and rent revenue also increasing with the credit. Then on January 31st, when we go to pay, here we are actually receiving cash. And we're going to receive the cash for all 3 months. We received $15,000. First thing I would do is take our rent receivable off because they owe us $10,000. So now we can decrease this asset by making a credit entry of $10,000. And in order to make our journal entry balance here, we have another $5,000 credit, which is the rent revenue that was finally earned in December. We finally performed our service obligation by letting them use the building all of January. So then at the end of January, we can recognize that last amount of rent revenue. Okay, accrued expenses. Expenses that have been incurred but not yet recorded. A lot of these, such as payroll, taxes, utilities, rent, interest. Okay. This is where payroll could come in the middle of a week. For accrued expenses, our adjustment is always necessary to get the expense into the right period. And it's always going to have some kind of expense with it, which is the first even dealer. So it is our normal debit balance. And it's also going to create some kind of liability since it has not been paid, something we're going to pay in the future. Okay, so we pay our employees every 2 weeks. Employees work 5 days a week, a total of 10 work days every 2 weeks. Total wages for 10 days is $50,000. Also assume that December 31st is 4 days into a 10-day work period. Okay, so first thing we do here, December 31st is 4 days into a 10-day work period. So we've had 4 days worth of salaries that have been earned that have already been incurred during this reporting period, but we're going to pay them later. And we'll pay them at the end of the pay period. So our 2 accounts we're going to have here is a salaries expense because they have incurred that expense already, so we need to record it. And that's going to coincide with their payable. And we'll call that salaries payable. Calculate the amount of the adjustment. Well, if they got $50,000 for every 10 days, and 4 out of 10 days were worked in 2 weeks, we can take the 50,000, multiply it by 4/10, or 2/5, or 20%. However you would calculate that. Okay. You can find out that they have earned $20,000 of what they are going to be paid at the end of 2 weeks. So you'd have a salaries expense for $20,000, salaries payable for $20,000. And then on the day when we pay them, cash is going out from us. So where our asset is going down, so we make a credit entry. We would remove the payable that we owe them of $20,000. We would not need to expense it now that we're paying the cash because we've already put that in the right period. But they still earned $30,000 worth of expense was incurred during the period that we are currently in now. You have that multiple entry there to record the accrued expense. All right, at the end of the fiscal period, they omitted the adjusting entries for accrued salaries. The effect on this area of the financial statement is to, so they did not record that salaries expense and salaries payable. So what's it going to do to our financial statements? Our expenses are going to be lower than they should, which is going to make our income higher than it should be. So it's going to definitely see overstate net income. Okay, that's the effect it's going to have on the income statement. What effect is it going to have on the balance sheet? Well, we did not record a payable, so we are not going to have as much liability as we should have. So it's actually going to understate our liabilities. It's going to show that we owe less money than we actually owe at that point in time. So understate liability is not a choice. Our answer here is C, overstate net income. And next we have deferred revenues. Basically, these are your unearned revenues where cash has been paid. You cannot record it as revenue even though you got the cash. Unearned revenue is a liability on the balance sheet. It's something that we owe. Okay. Here, it's important to know when we receive the cash, if we haven't done any work, it goes into unearned revenue. Then as we start performing the work and services, we can earn it over time. Okay. So here we have kind of the same example. But this time they're going to pay in advance instead of waiting to pay after 3 months. They're going to pay on the first day of the lease with 3 months in advance in order to get a little discount. So November 1st, when they actually paid the $13,500, the initial recording, you would have to debit your cash, because an asset is going up, and credit unearned rent revenue. And that unearned, that is a liability. We still owe rent at this point because they have not used it up at all. Then when we get to December 31st, now we're getting ready to make a report and they have used 2 months of rent up. Okay. We performed our obligation. We've given them the building for 2 months. So now we can recognize 2 months worth of rent revenue, even though we're not getting cash at this point in time. So we are going to decrease the liability, the unearned rent revenue, by 2 months worth of rent, 4,500 times 2. When we decrease the liability, now we actually recognize or record the revenue as rent revenue, increasing it with a credit entry. We'll go back to what I was going to show you. Then we would come again and we would get to January 31st of the next year. And that's when we would do the remaining 4,500. It would be the exact same journal entry. Okay, then we take off all of the unearned rent revenue and put it into rent revenue. Then on February 1st, when they paid 3 months again, we'd start the whole process over. Okay, so deferred or prepaid expenses. Okay, this can be rent, advertising, insurance, supplies is one of these, because even though it doesn't create a prepaid supplies expense, it creates a supplies account, which we're going to need to adjust so we can expense what we actually used out of the supplies. Okay, so most of them are going to be known as prepaid. Just remember, supplies is one that sneaks in here that's kind of not. We're always going to create an expense, and we are always going to lower an asset with this. So we will debit our expense and credit an asset. All right. Ooh, lost my lights. All right, these quarter properties had 4,581 office supplies at hand at the beginning of November. On November 10th, they purchased office supplies totaling whatever. So when they got it in, of course, when supplies came in, they would debit their supplies or increase them and credit their accounts payable or cash, however they went about paying this bill. At the end of the year, the balance in supplies was, so it's telling us that they should have 16,946 supplies. Count of the office supplies on hand indicated there was actually only 3,263. So here we've recorded supplies every time we bought them. But when we get to a reporting period, we need to figure out how much of these supplies that we actually use, not everything we bought. So what do? You go back and you count what you have left. Okay, whatever the difference between those two is, that is the amount of supplies that you're going to use. Say you have used up. That is the amount that you need to create a supply expense for. And then you can just lower your supplies account because you do not have them. Okay. So in order to get this, we have supplies. You know, we're gonna do supplies expense. Okay. November 10th, the purchase of supplies. See, we increased our supplies here on November 10th and cash went out. There is no expense at this point, even though the cash was paid. When we get to the end of the year now, we're going to make that adjusting entry. We're going to create the expense. We're actually going to lower the amount of supplies, the asset them. So that way, our balance sheet is going to show exactly how many supplies we have, and we get the correct expense onto our income statement. We calculated that by total supplies available minus the supplies on hand, means that's how many they had to use, and that would be our adjusting entry. All right, so if our supplies account showed a beginning balance of 3,000 and supplies are purchased for 5,500 during the period, with the supplies inventory at year end of 1,700, this entry involves A. Well, first, we need to make an adjusting entry for supplies. We're gonna have a debit to supplies expense and a credit to supplies, because our supplies are actually going down. So we can eliminate B and D right away. Next, we need to remember how to measure the amount. We take the beginning balance of 3,000 plus the 5,500, so we have 8,500 available, supplies available. And we had 1,700 at the year end, so if we took 8,500 minus the 1,700 that we have remaining, we would see that we used up 6,800, so we want to debit our supplies expense for 6,800. And to be correct, we would credit supplies for 6,800. The last type of adjusting entry we have to talk about is depreciation. Depreciation is kind of like a prepaid expense. But whenever a company purchases property, plant, and equipment, so they spend $100,000 cash to buy a big old backhoe, they put it on their books as equipment, which is a debit and asset, and they would credit the cash going out that they paid. You see, there is no expense created right there because they expect to use that piece of equipment for a long time to generate revenue. So they decide to get rid of that by a process called depreciation. Okay, so every time you do a report, you create your report, you need to, a company is going to have to make an adjusting entry for depreciation expense. Okay, that is expensing off the original cost of property, plant, and equipment. When they do that, it's going to create a contra account. Okay, contra accounts are accounts that are linked to a specific balance sheet account. It just makes them lower. So here our contra account is going to be called accumulated depreciation. If you were to look at a balance sheet, it would say our equipment was $100,000. That was the original cost. And then it'll say less accumulated depreciation. Maybe we have expensed off 40,000 of it. So what we have it on our books is that it's cost minus accumulated depreciation, or 60,000 at this point. That would be what it's referred to as having its book value. Okay, has nothing to do with what you can be able to run software, not the fair market value. It's just how we are recording it onto our balance sheet. Okay. So kind of just to recap, depreciation is expensing the original cost of a long-term asset over the life of the asset. It is going to create a depreciation expense as a debit, and it's going to create this contra account, which is linked to property, plant, and equipment, but only it's going to have a credit balance. Okay, so we would debit depreciation expense, credit accumulated depreciation. And here, every question you're going to have, it's going to give you what the amount of depreciation expense is. There's multiple ways to do that, and when we get into chapter 7 of this book, we are going to learn those multiple ways. But here we have an office building, the depreciation expense on this building is. Okay, so you have to think, we need to do an adjusting entry, depreciation expense, and then that contra account, accumulated depreciation is always linked on it with this when we're making this entry. And it gives us the amount of $15,000. So debit your expense, credit your contra account, and that's the entry. Here again, here's how it's shown. It would say property, plant, and equipment. Net right here is $1,450. Then you have to go to the notes and say that the building was 400. Building had 450,000 minus the 45,000 accumulation, getting us to 405,000. Okay, that'd be shown in the notes. That 405 is obviously part of that amount right there. But here are just some practice ones. Okay. I'm just going to kind of flip through. I like to try them on your own. I'm not going to explain them. Right. Maybe I'll explain. No payable for 2000 requires interest paid at an annual rate of 8%. Important to note here when they give you that 8%, that is an annual percentage rate. So you need to break it down into months. So we signed on March 2nd, on March 31st, we owe 1 month worth of interest. We were making our thing here. So it'd be 3,000 times the rate of 8% times 112. It shows that of all the interest that we're going to pay on this note, we owe $20 of it. So we done an interest expense, then we're going to pay back. We'll pay back the note and interest payable. All right, so that's it for this video. I want you to go through those practice ones. All right. As I was saying, you're ready for chapter 3, handout 1 now. I saw the microphone went out. I'm not sure when it went out. But you're going to do that. And then you can watch the chapter 3 lecture video 2 and help you with handout, chapter 3, handout 2. I'll talk to you again soon.